Hey guys, it is Julie here with TipRanks. Today we're taking a look at 4 Dividend Aristocrats, so let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we are taking a look at Dividend Aristocrats. These are companies that have been increasing and paying out their dividend every single year for at least 25 years. So they are great ones to look at if you want some of that stable passive income. Plus they can be great holds for long-term investments. We're going to take a look at these companies, what it is that they do, and how the analysts have been weighing in lately. Don't forget to make sure you've downloaded the TipRanks mobile app if you want to access some of your favorite investment research tools on the go. Links will be in the description down below. Now let's jump right into these 4 Dividend Aristocrat stocks. First up today, we're taking a look at Albemarle. Their stock trades under the ticker ALB, currently priced at $152 per share, and they are trading near their 52-week low. The stock is down 45% in the last year and 32% in just the last few months, but maybe a bottom is in sight. Lithium prices have been weak in 2023, which has caused some of this downward pressure on the Albemarle stock. But when we look long term, with increasing EV demand, they expect lithium demand to also rise. And Albemarle is known as one of the world's leading lithium miners. On top of that, they're one of the world's largest producers of bromine and one of the major producers of oil refining catalysts. The company is working on expanding their own lithium mining and extracting operations in Nevada, Chile, and Australia. And in addition, they keep growing their capacity by taking over lithium producers around the world. As a Dividend Aristocrat, this company has been increasing and paying out their dividend for 29 consecutive years. Their current quarterly dividend comes in at 40 cents per share for a dividend yield of 0.98%. They'll be sharing their next quarterly report in just a few weeks on November 1st, and this follows a couple of quarters where they came out with a pretty sizable earnings beat. Analysts will be anticipating earnings per share of $3.87, which is about half of the previous year. When we take a look at their last quarter, analysts were expecting $4.48, and they came out with a $7.33 earnings per share beat. Their previous quarter back in May also came out a few dollars ahead of expectations. For their Q2, they saw net sales of $2.4 billion, which was an increase of 60%. Last week, an analyst from RBC Capital reiterated their buy rating with a pretty bullish outlook on the stock. They said that the firm's lithium supply-demand model reaching out to 2035 suggests fundamentals supporting the elevated lithium prices, which should be a positive long-term tailwind for Albemarle. The stock is also among RBC's top 30 global ideas list. Their price target of $260 on the stock would imply upside of about 70%, so some healthy recovery there. Overall, the stock comes in as a moderate buy. With 13 buy ratings, 3 holds, and 1 sell, the average price target comes in at $262, which would be an upside of about 71%. Down below, we can see that RBC rating here. On the low end, we do have a couple holds, still with upsides of 39 and 48%, and a high-end price target from Loop Capital Markets with upside of about 120%. Our second Dividend Aristocrat today is Sherwin Williams. Their stock trades under the ticker SHW, currently priced at $253 per share. They have seen growth of 18% over this past year, cooling off ever so slightly in the last few months, down to about 1.4%. Sherwin Williams is a painting and coating manufacturer. They supply stains, equipment and floor covering products, architectural paints, coatings, and varnishes. They sell their products to professionals, industrial, retail, and commercial clients. They have one of the industry's most recognized portfolios of branded and private label products that are sold across a chain of more than 5,000 company-operated stores. This Dividend Aristocrat is beginning to near king status, as they have 45 years of increases in dividend payments. Their current quarterly dividend is 60 cents per share for a dividend yield of 0.97%. And they also have an earnings report coming up in just a few weeks on October 24th. For their Q3, analysts will be looking for earnings per share of $2.76, down slightly from the previous year. This follows their Q2, where they did come out with an earnings beat, reporting earnings per share of $3.29, nearly 60 cents ahead of analysts' expectations. The company had consolidated net sales increase 6.3% to a record $6.24 billion. Just a few days ago, one analyst from Mizuho Securities reiterated their buy rating. Chris Parkinson expressed confidence in the company's ability to consistently outgrow its key markets, particularly in the residential, repaint/new residential, protective, and coil sectors. They also highlighted the company's unwavering focus on share gains and their optimal positioning to address the acute U.S. housing shortage. Their buy rating on the Sherwin Williams stock comes with a price target of $305, which would be an upside potential of about 20%, and they are one of 18 ratings on the stock, which comes in as a moderate buy. That breaks down to 11 buy ratings, 6 holds, and 1 sell, with an average price target just shy of $300 per share, which would be a growth potential of over 18%. Here we can see the Mizuho Securities rating with that 20% upside. We do have a recent hold with a downside of about 1.6%, and the rest ranging in those high teens to low 20s, with a high-end price target hitting about 30% upside. Third on our list today is Cintas Corporation. Their stock trades under the ticker CTAS, priced at $480 per share. They've seen growth of 18% in the past year and have cooled off ever so slightly, down 1% in the last 3 months. Cintas is primarily known for renting business uniforms. They are actually the leading supplier of rental uniforms in the United States, with a market share of more than 25% and serving more than 1 million customers. They rent uniforms but also provide laundry services, pickup, and delivery. And on top of that, they also provide other services like entrance mats, sanitation supplies, and clean room supplies. Their dividend has an impressive track record with 40 years of consecutive payments and increases. Their quarterly dividend is currently $1.35 per share for a dividend yield of 1%. They just reported their most recent quarterly earnings near the end of August, and they did come out with both an earnings and revenue beat. For Q1, they reported revenue of $2.34 billion, and that grew about 10% year over year. Earnings per share came in at $3.70, beating expectations by 3 cents per share. The company also announced that they were increasing their full fiscal year guidance and raising their annual revenue expectations to $9.4 to $9.52 billion. Following this, just a few days ago, the Cintas stock was upgraded to a conviction buy at Goldman Sachs. They said that the company's organic growth has structurally reset higher than pre-COVID levels, rising to 7 to 8%, driven by volumes and an expanded opportunity in delivering uniforms into the healthcare vertical, as well as ongoing penetration of the unvended market. They give the stock a buy rating with a price target of $592, which would imply upside potential of about 23%. Overall, the Cintas stock does come in as a moderate buy. With 13 current analyst ratings, with 9 buys and 4 holds, the average price target of $537 would be an upside potential just shy of 12%. And you can see that most recent rating here from Goldman Sachs. On the low end, we do have a hold from 3 months ago with a downside of 8% and a lot ranging around that 9 to 16% upside, with a 19.78% upside being our high-end price target. And last but not least today, we are looking at Linde. They trade under the ticker LIN and are priced at $370 per share. This is another company that has seen notable growth this past year, up over 34%, trading fairly flat in the last few months. Linde is the largest company in the global industrial gas niche. Originating in Germany, they've been in business for almost a century and a half. They are a leading provider of atmospheric gases such as argon, nitrogen, and oxygen, along with volatiles like hydrogen. Linde can provide gases in pure or mixed forms and offers engineering expertise in pressurizing or liquefying gases. This Dividend Aristocrat has 31 years of dividend payments and increases under their belt, with a current quarterly dividend of $1.27 for a dividend yield of 1.34%. Their next earnings report is coming up in a few weeks on October 26th, and it will follow a long string of earnings beats for the company. Analysts will be looking for earnings per share of $3.58, which is an increase year over year. And you can see down below what I mean here about that long track record of earnings beats. So hopefully no surprises coming up on October 26th. In their Q2, they beat expectations by 7 cents per share. And while they did see their sales of $8.2 billion fall 3% year over year, they did increase their full year 2023 earnings per share guidance. The Linde stock is currently rated a strong buy, and a couple months ago following that last earnings report, we had a ton of analysts increasing their price targets. Looking at our detailed analyst ratings, we can see pretty much all of them raising their price targets on the Linde stock and maintaining their buy. On the low end, we do have a hold rating from Mizuho with an upside of nearly 11%, a lot of them in the mid-teens to low 20s, with a high-end price target of 25% coming from Argus Research. The most recent came just a couple days ago from Citi Financial with a price target of $450. Their strong buy rating is based on 14 buys and just 1 hold, with an average upside of 17.5%. So that is a quick look at 4 Dividend Aristocrat stocks. Let me know your thoughts on these companies in the comments down below and what other dividend royalty you love. I always appreciate hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those analysts are looking at and providing some insight and entertainment. So please make sure you're always doing your own due diligence and research. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.